bought a place like a lot of our listeners did, and you move out and you continue to build your real estate portfolio long-term. Talk through some of the strategies just overall that people maybe don't understand or don't realize are out there for real estate investors.
I guess I'll hit on the one that I'm pretty passionate about right now. I'm actually executing this myself, and I've executed this for a couple of clients. There's what's called bonus depreciation that Trump enacted, and it's going to start phasing out here. I think this is the last year you get 100% bonus depreciation. It's going to continue to decrease. So one strategy that I'm looking into to kind of increase my bandwidth and start to collect more properties is, if I'm not a real estate professional, I can't offset any of my W-2 income or business income, but there's a unique rule for like hotels. If their average stay is under 7 days, is it really fair for them not to be able to take these losses? I mean, they're running a business at the end of the day. This isn't passive rental activity. If you do some good documenting and some good planning, you can go ahead and buy a property and rent it out on VRBO or Airbnb for under 7 days on average throughout the year. And if you have enough material participation hours in that activity and you meet the different like stay requirements, there's a long list of things that you need to qualify for. You can do what's called a cost segregation study. And so what this does is engineers go into the home, they break up the house. So the structure of a house, you have to depreciate over 27 and a half years. Well, your carpet doesn't need to be depreciated 27 and a half years. Your appliances don't need to be depreciated 27 and a half years. But when you buy a house, the IRS doesn't expect people to go and portion out every piece of their house to increase those depreciation schedules. So when you break up a house, you have an engineer actually come in and put a price to different components of your home, the windows, the flooring, the cabinetry, whatever it is. You can start to go from depreciating that over 27 and a half to depreciating it over 10, 15, 5, 7 years. So faster depreciation. But anything under that 15-year depreciation mark, you can actually bonus depreciate. So what I've been seeing is, if you actually execute on this strategy and do a cost segregation study and take the bonus depreciation, you can recapture about 30% of the purchase price of the home in that first year. So if you buy a $100,000 house, you cost segregate it, you should get about a $20,000 to $30,000 deduction on your income. And because you're following this really niche rule of basically it's hotel law, if you follow this niche rule, I'm actually able to decrease my active income, my business and my W-2 income with this deduction. So I could buy a $100,000 house and take a $20,000 decrease in my W-2 income. And I mean, obviously that's huge. If you Google search it, there's a lot of information around it. It's extremely powerful and something that I've become pretty passionate about. I'm executing that one myself. So that's one way where you can start to increase these depreciations and get you into houses faster and help you grow your portfolio quicker. What other questions you got? Like you said, like not traditional house hacker.
Maybe somebody just beyond house hack. They've done one, or they have ambition to do one or two. Like, what can they look forward to? What should they start planning for? They just bought one this last year, but in 5-10 years, they want to grow a portfolio, 10, 20, 50, 100, whatever it is that their ambition is to grow a real estate portfolio. Like, what are some of the things that beyond house hacking that they can take advantage of? What should they prep for? Things of that nature.
Yeah, well, one sick thing that you should be pretty pumped about is you're going to have tax-free income on any of those properties. You should be able to capture all the expenses and just off the depreciation schedules of the house and the condition you bought it in, and any renovations and anything you do, you should offset any income coming into those houses. Now, what that takes is a lot of planning. You need to meet with your CPA and your advisor. You need to accurately and diligently portion out your expenses. If you hand an accountant numbers at the end of the year or during tax season, there's nothing that can be done. That's over with. If you hand it to them in February, they're just going to do your return, and they're really not providing any value. And not many good CPAs want to just do a tax return. That's not really fun. So you should be meeting with your advisor quarterly. That's the biggest thing, is you're going to have tax-free income. As far as, you know, I'm trying to think of some of the more unique things we do. I mean, another thing too is like, if like in the future, you know, you're going to have more tax deductible, you're going to have more expenses that are deductible. So another one, I got Home Depot like 10 minutes away from me. So I keep accurate books and then I apply the mileage rate to going to Home Depot and back. There's just a lot of small deductions that a lot of people miss that you can actually take advantage of as you start to grow your rental portfolio. And then I spoke on bonus depreciation. The thing that stinks with bonus depreciation though is, like I said earlier, if you're not qualifying as a real estate professional or using some more advanced strategies to actually take these losses, I mean, you can supercharge your losses all you want, but you're just going to end up having to suspend them and roll them forward, which can be powerful too. I mean, if you want to sell in the future, you have other passive income coming in, like you can use those passive losses. I just see that a lot of people end up not being able to use them, well, which kind of stinks.
One thing, the 2-year rule, like if you live in a property for 2 years and you sell it later down the road, it's going to reduce your tax bill. My understanding is that's going to be a little bit different if you're house hacking a multi-unit versus house hacking a single family. Can you go into detail of more specifics of exactly how that rule works and then how it's going to be different for the different type of house hacks?
Yeah, for sure. So if you have a house that you live in for 2 of the past 5 years, you can sell it, any of that gain, not taxable. Very common. I mean, everyone uses it, obviously. If you're single, you don't have to pay taxes on $250,000 a gain. And then if you're married, filing jointly, it's $500,000. Thanks for bringing this up because this is a good point, and it definitely needs to be considered. My situation, I was buying a single family home. I knew I had a big equity play. If I was just trying to make money and kind of like get my jump start into real estate, but didn't really know if I wanted to have rentals long term, I probably would have just moved in and did a live and flip, because the 2-year mark's about to hit and I could sell this house, take all the gains out and not pay taxes on it. At the end of the day, that's not what I want to do. I want to hold properties for the long term. I mean, I have this house at a 3.1% rate. I am not selling this house. I can promise you that, especially when you can borrow against it. I probably would have not rented it out and would have sold it and not paid tax on those gains. But since I am renting it out, it's a 3-bedroom. So you got to take 2/3 of that. If I were to sell, I could not get tax-free gains on 2/3 of that sale or of that gain. Does that make sense? And that goes the same with like a duplex. I mean, if you're renting out one side, living in the other side, you can only take a 50% tax-free gain because you rented out the other side. There's a little bit of flexibility with this too. It's 2 of the last 5 years. You have to have it as a primary residence. So you could live in it your first year. You're the only person living in it. You're renovating the other unit. You get a girlfriend, you decide to move, you rent out both units for the next 3 years, and then you move back into it and you kick out the other person. You live in that again for that last year. That's still 2 of the last 5 years. You can still take that gain because it was your primary residence for 2 of the last 5 years. It doesn't have to be consecutive.
Yeah, I mean, you could even, if you're in a duplex, you live in one unit, the other unit opens up, and if you're going to be there for 4 years, hop over to the other unit, live there for 2 years, and that's going to hit that mark too.
Absolutely, yeah. And it's just always everyone's personal circumstances. You know, what are your goals? What are you trying to do in real estate? That's another thing. I always get eerie about giving any tax advice or tax tips over the internet just because people read a forum or they hear some advice. And yes, I mean, usually it is true. You can do these things, but there are so many rules and things you need to actually qualify for in order to take advantage of those strategies or whatever it is.
And that's why it's so important to have somebody like Cody in your corner and to talk through it and to understand what you're doing, the implications of it, and the long-term play too. Sometimes it's to take short-term tax gains. Sometimes it's good to delay those gains or whatever long-term